Imagine you are scanning the financial headlines over your morning coffee, right? And a very specific metric just jumps right off the screen at you. 238% year-over-year revenue growth.
Right, which is, I mean, that's a wild number to see before you've even finished your coffee.
Exactly. Usually when you see a number like that, you just assume you're looking at, the next big Silicon Valley unicorn.
Yeah, you probably picture a viral consumer app or maybe a hyper-aggressive cybersecurity firm that just landed some massive Department of Defense contract.
Right, exactly. But then you look closer at the document we have sitting on the table today, and you realize you aren't looking at a standard Silicon Valley darling at all. You are looking at the Q1 2026 financial results for a company called Gloo Holdings, Inc.
And their target market is, well, it's completely unexpected.
It really is. They operate in what they call the faith and flourishing ecosystem. We're talking about serving 140,000 faith, ministry, and nonprofit leaders. So welcome to the deep dive.
Thanks. It's a really fascinating space to look into.
Yeah, our mission today for you listening is to figure out how a company operating in this highly specific, traditionally, legacy sector is generating absolute hyper-growth tech numbers. We are going to look at how they're leveraging bleeding-edge AI to completely modernize legacy institutions.
Yeah, it's a striking intersection because when you parse these earnings, it becomes clear pretty quickly that this isn't just a story about a company with a really persuasive sales team selling a niche product.
Right, it's much bigger than that.
Exactly. This is a story about applied AI functioning as a massive force multiplier and doing it for a previously underserved demographic. Glue is basically taking highly advanced technological infrastructure and applying it to organizations that, historically, have kind of been left behind by the rapid tech boom of the last 2 decades.
Okay, let's unpack this, because to understand the strategy here, we really need to start by looking at the sheer scale of the headline numbers. The Q1 2026 press release from June 8th is staggering, but it requires a little bit of translating, I think.
Yeah, you have to look past just the top line.
Right. So total revenue for the first quarter hit $41.5 million. That beat the consensus estimates of $36 million by a mile.
A huge beat. And if we break down the financial tables, we can actually see the anatomy of that revenue. They categorize it into 2 main streams.
Okay, what are those?
So you have platform revenue, which brought in $24.1 million. And then you have platform solutions revenue, which accounted for the remaining $17.4 million. Both of those segments are firing simultaneously to achieve that 238% growth compared to the prior year.
I am looking at the bottom line here, though, and I have to push back a little on the pure celebration of that $41.5 million revenue number.
Oh, sure.
Because even with all that money coming in, they still reported a net loss of $17.1 million for this quarter.
Right.
Yes, I mean, that is a significant improvement from the $27 million loss they took in Q1 of 2025. But a $17 million net loss means they are still burning a mountain of cash.
They absolutely are.
Yet Gloo's CFO, Paul Seaman, seems entirely focused on a totally different metric in his commentary. He keeps pointing to their adjusted EBITDA, which came in at negative $11.5 million.
Right.
I understand that EBITDA stands for earnings before interest, taxes, depreciation, and amortization, but why focus so heavily on that specific adjusted metric when the net loss looks so much worse?
Well, what's fascinating here is how adjusted EBITDA acts as a much clearer lens for the core operating performance of a high-growth software as a service or a SaaS company.
Because the net loss includes stuff that doesn't actually impact the daily cash flow.
Exactly. A net loss figure includes a lot of non-cash expenses. It includes depreciation of assets, amortization, and massive equity-based compensation packages for employees. It also includes interest expenses and taxes.
Right. Okay.
By stripping all of that away, adjusted EBITDA gives you a look at the actual cash the day-to-day operations of the business are generating or, in this case, burning.
So it's essentially a way of saying, like, if you set aside the complex accounting rules and the cost of servicing our debt, here is the raw health of the actual business engine.
That is the exact argument management is making. And when you look through that specific lens, the engine is actually running increasingly well.
Even at negative 11.5 million.
Yeah, because that negative 11.5 million beat both their own internal guidance and the analyst consensus.
Yeah.
But even more importantly, it represents a massive sequential improvement. Just looking from the fourth quarter of 2025 to this first quarter of 2026, their EBITDA improved by $7.1 million in just a matter of months.
Wow, okay.
Yeah, that signals significant operating leverage.
Which means their revenues are finally growing at a much faster rate than their foundational costs,
Hmm.
but they are absolutely still spending heavily to get there. Like the earnings report shows, they spent $3.8 million dollars on product development and nearly $9.6 million dollars on sales and marketing just in this single quarter.
Right, but in the high-growth SaaS world, that level of spend is just standard operating procedure.
You have to spend money to make money.
Exactly. You burn cash aggressively to capture market share and build a defensible product. The bet is that once those customers are locked into your platform, the revenue becomes highly recurring, the marketing costs per user drop, and your margins just expand rapidly.
But capturing that market share requires a very specific approach because they didn't get to 41.5 million in a single quarter by just selling $50 a month software subscriptions to local youth groups.
No, definitely not.
To justify a $9.6 million sales and marketing spend, they have to be doing some serious whale hunting. We are talking massive enterprise deals.
Yeah, Gloo refers to this as their ecosystem approach. They're aiming at the very top of the institutional pyramid.
Right. The report states they closed 5 new customers in Q1 2026 alone that each contribute over $1 million in annual contract value.
Which is huge for this sector.
Oh, it's massive. And they are expanding way beyond their initial base, showing real traction in the Catholic sector with universities, rescue missions, global Bible translation organizations. There are 2 specific mega partnerships mentioned that really illustrate the massive scale we are talking about here.
Let's hear them.
First, you have the Assemblies of God. Gloo is deploying a platform called Gloo 360 across their entire enterprise operation. This is designed to serve 3 million members across 13,000 separate churches in the United States.
The logistics of that alone are staggering. Just
Yeah.
trying to onboard 13,000 churches onto one system.
Insane, right? And then the second major deal is with Wesley Seminary at Indiana Wesleyan University. They are building something called VIA Journeys, which is an AI-powered ecosystem connecting ministry leaders with personalized resources and mentors.
Right.
To visualize this, I keep imagining these massive historical organizations that for decades have relied on clipboards in the lobby, physical sign-up sheets, massive phone trees, and maybe some really clunky legacy software built back in 2004.
Oh, the 2004 software is too real.
Right. But Gloo isn't just coming in and updating their website. Gloo is installing a massive, state-of-the-art digital nervous system straight into the spine of these institutions.
It's a great analogy, and it goes even deeper than that when you consider the financial durability of these contracts. These aren't just one-off software sales, right? When you deploy a centralized system across 13,000 independent churches, or when you become the underlying digital infrastructure for how a major university mentors its students, you are fundamentally transforming their daily operations.
You aren't just an app on their phone, you are the operating system.
Exactly. The switching costs become astronomically high. A massive organization cannot easily just rip out a digital nervous system once all its data, communication, and member management are flowing through it.
Oh, yeah. It would be a nightmare to migrate off of that.
It would be. So those million-dollar annual contracts are incredibly sticky. They provide a rock-solid foundation of predictable, recurring revenue. And investors love that kind of predictability.
But securing a mega deal with a deeply traditional religious institution requires more than just a slick sales pitch. A university or a global church network isn't going to hand over its sensitive member data and its pastoral care communications to just any random SaaS company.
Oh, the trust barrier is extremely high.
So why are they trusting Gloo specifically?
Well, that brings us to the technology itself, specifically their approach to applied AI. In the report, Gloo CEO, Scott Beck, explicitly calls AI a, quote, force multiplier. They are focusing heavily on what they call agentic AI and foundational models.
Okay.
And we can see the mechanics of this in their partnership with Jessup University, which the report actually notes is running ahead of schedule. They are deploying an AI student success platform that gives coaches, faculty, and parents real-time risk assessments, attendance visibility, and automated communication tools.
So if a student misses 3 classes and their grades drop, the AI doesn't just log it in some spreadsheet. It actively flags the risk and coordinates a communication chain between a success coach, the professor, and maybe even the parents to intervene.
Exactly. It acts as an automated safety net. But here's where it gets really interesting. The report announces the broad availability of something called Gloo AI Studio.
Oh, yeah, I saw this.
Yeah, this is a developer suite supporting over 80 large language models, or LLMs.
The part of the AI studio announcement that immediately jumps out to me is a feature they describe as a playground with, quote, values-aligned guardrails. I really want to pause on this concept because what does a values-aligned guardrail actually mean in practice? Like, how does an AI built for a faith-based nonprofit function differently than if I just set up a standard ChatGPT instance for a university?
That is the million-dollar question. And it really comes down to the distinct safety, ethical, and theological requirements of the faith and flourishing sector. General AI models, by their very nature, are designed to synthesize the entire internet,
Right.
so they can hallucinate facts, or they can provide responses that are entirely secular. Worse, they might offer advice that is wildly out of sync with an organization's core moral tenets.
Oh, that makes sense.
Imagine a student reaches out to an automated coaching AI at a deeply conservative religious university in a moment of personal crisis. That university needs an absolute ironclad guarantee that the AI's response will align with its specific institutional values.
I see. So if a student asks a general AI for life advice, they might get a secular, purely psychological response based on popular internet consensus. But a religious institution might require the AI to incorporate specific scripture or at least adhere strictly to their faith-based counseling principles.
Exactly. Or, fundamentally, they just need strict parameters ensuring the AI never contradicts their official teachings. By building the Gloo AI Studio with these values-aligned guardrails built in from the ground up, Gloo is executing a really brilliant strategy.
It's a massive aha moment when you think
Uh-huh.
about it. Right now, every major tech company in Silicon Valley is racing to build artificial general intelligence, an AI that can do absolutely everything for everyone.
Right.
But Gloo is reaching a massive valuation by doing the exact opposite. They are building AI that is highly constrained, highly dogmatic, and hyper-specialized.
They are turning constraint into a premium feature. And by doing so, they are positioning themselves as the foundational infrastructure for this entire demographic.
Yeah.
They aren't trying to build every single app for every single church or university themselves.
Oh, so they let others build it.
Yeah, they're offering varied subscription options for token usage, and they're saying to outside developers, come build your app on our secure, values-aligned sandbox. In the middle of the AI gold rush, Gloo is selling the picks and shovels.
And they're aggressively courting the developers who will use those tools. The report mentions they are hosting their 4th annual AI hackathon in Boulder, Colorado this October.
Yeah, October 6th through the 8th.
Right. And they expect over 700 developers, engineers, and mission-driven builders to attend. They are literally cultivating an entire developer ecosystem that will be completely reliant on their proprietary AI studio.
Hosting 700 developers to build out tools for human flourishing is a massive undertaking. But the operational lift of all of this is what really stands out to me. Building out 80-plus LLM integrations, running a global developer network, and deploying enterprise systems to 13,000 churches simultaneously. That usually takes years of organic growth.
Which brings up an unavoidable question. How did they build all this capability in just a few quarters? I mean, you don't just put up a few job postings on LinkedIn and organically hire your way to a state-of-the-art 80 LLM AI infrastructure overnight.
You don't, you buy it.
Ah.
Gloo has been exceptionally aggressive on the M&A front, mergers and acquisitions. The report outlines a flywheel effect created by strategic acquisitions they've already integrated, like the Westfall Group and Masterworks. But there are two massive deals highlighted for this specific quarter that reveal their underlying strategy.
Let's look at the EMD deal first. Announced in Q1 and closed in Q2, they acquired a company called EMD, which is an established Workday services partner. This instantly adds AI-enabled Workday consulting, implementation, and support for nonprofits right into Gloo's portfolio. It really feels like Gloo is assembling a tech supersuit. Like, instead of spending 3 years building an HR and finance tech consulting wing from scratch, they just snap on EMD's arm, and suddenly they have elite Workday expertise to offer these mid-market nonprofits.
It is an incredibly efficient way to grow, provided you have the management capability to integrate the teams. But the second deal, the Midwestern deal, is particularly fascinating from a balance sheet perspective. Gloo announced an agreement to acquire the remaining 20% stake in a company called Midwestern, bringing their ownership to a full 100%.
Right, which secures global AI engineering talent, which fits the supersuit analogy perfectly. But you mentioned the balance sheet. I'm looking at the financial tables, and under liabilities, there's a very specific line item for an, a quote, MW call option, valued at $12.1 million. I know this ties into the Midwestern deal, but I need some help translating this for us. Why is a call option sitting on their books as a massive $12 million weight, and how does buying the company actually fix it?
So let's break down what that call option actually represents. When Gloo initially bought the first 80% of Midwestern, they likely structured the deal with an option, a right to buy the remaining 20% later at a predetermined price or formula.
Okay.
But accounting rules are very strict. Because Gloo holds this option, and the value of Midwestern is presumably growing, the accountants require Gloo to log that potential future payout as liability on their balance sheet today.
Oh, I see. Think of it like a reservation fee or putting something massive on layaway. Glue promised they had the right to buy that remaining 20%. The accountants look at that and say, okay, that promise is a heavy financial weight hanging over your head. We have to record that as a $12.1 million liability.
That is a great way to look at it. It's a looming obligation. But by finalizing this acquisition and paying for that remaining 20% now, the transaction fulfills the terms of the option. The option ceases to exist. Therefore, that $12.1 million liability is completely wiped off Gloo's balance sheet.
Wow. So they secure the global AI talent, they get full, unmitigated control of the asset to integrate into their AI studio, and their balance sheet instantly looks $12 million healthier overnight.
It's a vital strategic move.
Right.
When a company is burning as much cash as Gloo is right now,
Mm-hmm.
optics matter immensely to investors. Wiping $12 million off the liability column buys them crucial narrative breathing room as they try to convince the market that they are on the verge of real, sustained profitability.
Buying that breathing room is critical because acquiring companies and hosting massive hackathons is not cheap. Let's look at the actual bank account. They have spent a mountain of cash to get here.
They have.
The cash flow statement shows their cash and cash equivalents dropped from $57.3 million at the end of January 2026 down to $33.0 million by April 30th. You have the $3.8 million spent on capitalized internal use software, plus the heavy cash used in daily operations. They're burning through their reserves at a notable clip.
They're definitely burning cash.
Right.
But the future outlook management provided in this release tells a story of a company that believes it is about to turn a very sharp corner.
Yeah, the Q2 2026 outlook projects $44.0 million in revenue, which would be a 172% year-over-year increase. And they expect adjusted EBITDA to be negative $8.5 million.
So they're still losing money, but less than the $11.5 million they lost this quarter.
Right, it's a continued sequential improvement. But the big headline is their full fiscal year 2026 outlook. Management raised their full-year revenue guidance to a massive $195.0 million, and their ultimate goal. They state they remain confident in approaching adjusted EBITDA break-even by Q3 2026 and hitting actual adjusted EBITDA profitability by Q4 2026.
Which is coming up fast.
Very fast. So what does this all mean? If I'm sitting there holding $33 million in cash and burning over $11 million a quarter, is this Q4 profitability target realistic? I've heard of the J-curve in venture capital and SaaS startups where the financials get significantly worse before they suddenly get astronomically better. Is that what we are looking at here? Are they just sitting in the belly of the curve right now?
If we connect this to the bigger picture, the J-curve is exactly the right framework for this. Imagine tracing the letter J. The line dips down deep into negative territory before sharply rising up into the positive. Gloo has already absorbed the phenomenally heavy upfront costs at the bottom of that curve.
Right.
They spent the capital to acquire EMD in Midwestern. They secured the global engineering talent. They built the 80-plus LLM integrations into their AI studio.
So the heavy lifting is done, the infrastructure is built.
Largely, yes. Now, as those multi-million-dollar annual contracts with massive organizations like the Assemblies of God start providing reliable, recurring revenue, the operational costs do not rise proportionally. It does not cost Gloo twice as much money to host 2 million users as it does to host 1 million.
Because the servers and the software are already in place.
Exactly. So the revenue line starts climbing sharply, while the development and operational cost lines stay relatively flat. That is when margins expand rapidly. The fact that management felt confident enough to publicly raise their full-year guidance to $195 million is a very strong signal. They can clearly see the upward sweep of that J-curve approaching.
It really is a masterclass in aggressive, targeted scaling. So to summarize for you listening, Glue Holdings isn't just selling digital tools to churches and nonprofits. They have systematically used strategic enterprise mega deals to embed themselves as the operational nervous system of these institutions. They realized that general AI wouldn't work for this demographic, so they built highly specialized, quote, values-aligned AI infrastructure that turns constraint into a billion-dollar feature. They've used shrewd M&A maneuvers to snap on workday expertise, secure global talent, and clean up their balance sheet liabilities, all of which has fueled an insane 238% growth rate, putting them on a dead sprint toward profitability by the end of 2026. It is a remarkable, highly unusual business story.
It really is.
But as we wrap up this deep dive, I want to leave you with a thought that goes beyond the balance sheets, the J curves, and the EBITDA margins. We are watching organizations that have traditionally been rooted in the most deeply personal, face-to-face human relationships. We're talking about campus ministries, local pastoral care, and community rescue missions. We are watching them increasingly rely on algorithmic risk assessments, automated success coaches, and AI guardrails to interact with their people.
Yeah, the human element is shifting.
It is. So the
Mhm.
question to ponder is this. As this massive tech rollout continues, how will the very definition of human flourishing change? Does automating a massive network of care actually enhance the human connection by making sure no one falls through the cracks? Or does inserting an algorithm into a moment of deeply personal crisis fundamentally alter what that human connection means? We started by talking about the collision of deep tech and traditional institutions. Looking at Gloo's hyper-growth numbers, the technology has clearly arrived. The real question is how the humans will adapt to it.